Headline numbers here. No surprise in terms of investment banking. What do you make of them?
So far, FICC a miss, so that's obviously not great. That's been an area of disappointment. I guess over the last couple of years, they had done better in the first half. Things can be volatile. We're going to want to hear about what's going on there. We do know that competition remains very intense. We've heard that from some of the other banks. Equities, marginally better. I'd call that about in line. Investment banking fees better. We're just seeing that headline now. So I'm going to want to know where that came from. My guess is it's going to be the equity underwriting. We saw the strength across peers. That's a business that Goldman Sachs is a leader in. They were actually a leader in IPOs year to date. And debt capital markets better at Morgan Stanley. We'd expect to see some outperformance at Goldman also compared to the Bank of America, Citi, JP Morgans of this world, just given the environment and where the relative strength has been in that market.
Yeah, it's just a coincidence, but this is David Solomon's first quarterly announcement, and he tends to be in the investment banking sort.
Indeed.
And his first announcement comes out well in investment banking, not in FICC.
Yes, in equity capital markets up 70%. So I think that's the strongest result, at least in terms of year-over-year growth that we've seen across the peers. But it will be interesting to hear from Solomon, not just today, but perhaps in the coming months. Fixed income trading, there was a $1 billion, target, if you will. They didn't call it a target. They called it an opportunity over time. There's also an opportunity that they had sized from the Marcus business. We've had news reports that they're pulling back the target next year. That makes sense given the cycle that we're in. But what does that mean for the targets? What is there going to be some kind of change to this $5 billion target that was set out under Lloyd?
And just to sort of further dive into FICC a tiny bit here. So they did say that the loss in fixed income trading, that decline was due significantly lower revenue from interest rate products and lower revenue in credit and mortgage products. Sounds a little similar to what we heard from JP Morgan. They did see higher revenue from commodities and currencies, but not enough to offset the decline that they saw in credit. Also want to go back to the advisory fees that we saw. So their financial advisory net revenues look pretty good. They came in at $916 million. And specifically, if you look at, say, M&A, we've seen a lot of divergence in the M&A advisory fees, right? Like Citi was up. You had JP Morgan, you had Bank of America was down. Let me get my numbers out here. You had Morgan Stanley was down 8%, Bank of America down 30%, JP Morgan down 6%. What do you make of all that?
So for M&A, one of the things that we saw in this quarter was there's a lot of strength in announced deals, but due to the timing of deals, some of that might have gotten pushed to fourth quarter. Keep in mind, when it is an environment that's focused on larger deals, there can be more lumpiness in the numbers. Mm-hmm. Bank of America, I think, is the outlier across the banks, just because they had such a strong year last year. It looked like they were gaining share in that business. Now it looks like there's been some give back. They did say that their pipeline looks good on announced deals heading into the fourth quarter. So, perhaps there can be some recovery there. It's more important for Goldman Sachs, though. They are a leader in M&A business. It looks like they were flat year over year, so that's still a good result for the leader in that business, given some of the weakness we've seen at peers. Equity capital markets, I have to correct myself. It looks like it was double the year-ago quarter. Mm-hmm. And debt capital markets down 6% year over year. So it looks like Morgan Stanley showing, I guess, the biggest year over year increase in that business.